interesting. Let's look at the apartment business now across the three types of product classes. There is the high-rise downtown products. I'm going to start on the left of the chart and work my way over to the right. But going down, so we have downtown high-rise product. Then we have strong suburban product, yep, or smaller centers downtown. And then we have tertiary markets. So big city, medium city, and small city, right? So let's look at the rental rates. And this is the input that you need for that detailed financial pro forma. So for the rental rates, we're saying for downtown product, $3 to $4 per foot. It does go above $4, but let's just say $3 to $4 per foot. In the strong suburban and the good smaller centers in the downtown, $2 to $3 per foot, and in the tertiary markets, up to about $2 per square foot. Right now, determining the rent is one of the most critical things you have to do, and we're going to talk a lot about rent here in this session and future sessions, right? So now let's go across the table. So we're talking about building the three types of product. Where do you get your data from? Well, the further out you go into the suburbs, into the smaller towns, the less data that's available. So you got to make more assumptions. You've got to go further afield to find competitors and things like that, right? And we'll talk a lot in our session on rents as to how you set the rent properly. It's probably the most important variable that you input into your pro forma, and it's the one that you have the least amount of verification on, because there is no brand new building across the street that's identical to yours. That's the disadvantage, but that's also the advantage, because you're going to be a market maker in terms of the building you build. It's going to be brand new and the best in class. So then we talk about development yield. So let's go over about the middle of the table. Development yield is important, and development yield is your NOI over your total cost. Okay, so what we would expect at a very high level is the downtown product. Maybe it's about a 5% development yield, or 4 to 5. In the stronger suburban product, maybe it's about a 6% yield. In the tertiary markets, we're seeing developers get a 6 to 7% yield. Now, the next number that's important to is the exit cap rate. So that's the cap rate that you sell the building on, or that the lender values the building on. So that's going to determine your takeout financing. So what you want then is a spread between your development yield and your exit cap rate. So in the case of the tertiary market, right at the bottom, we say that your development yield is 6 to 7%, and let's say you're going to exit at a 5. So you could have a 100 to 200 point spread there, right? 200 points would be a great profit. Okay, so we're going to teach you that calculation, how you make it, and so on. Now, purchaser demand, it's high for the downtown product, it's medium for the suburban product, and it's going to be lower for the tertiary markets. But your yields are higher, right? So we covered land costs, the amenitization. We're going to talk about, you need high amenities in the downtown product, good amenities in suburban. Let's call it medium amenities in the tertiary markets. CMHC financing is available for everyone. And then we want to talk about unit size and unit mix, and it's going to vary significantly from what you build downtown to what you build in the suburbs to what you build in the smaller town. So, but that's a high level on the financials. This is the 30,000 foot overview, and this is a big picture, but we're going to drill down into the components of each one of these items.